You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. Be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. Let's get the ball rolling here on TWIFO. This Week in Futures Options, the program where the name pretty much says it all. We break down the week that was and indeed still is on the futures options side of the fence. So we'll talk maybe some ag, some metals, some energy, some equities, all of the above, mix it all in, maybe some mystery stuff, maybe some crypto. You never know what's going to come on our radar this week. Kicking things off a little bit early for you, right on the noggin here at the start time of 1:30 p.m. Central. A little bit early, actually, with the music and fun stuff, so we can just get rolling right on into the live stream here. My name is Mark Longo from the old OptionsInsider.com, as well as from the ever-exciting Options Insider Radio Network. If you like our stuff, you know where to find us on all the major platforms. And, of course, you can join us live every Thursday, 1:30 p.m. Central, right around that time there, for your daily, or I should say weekly dose of TWIFO. And, of course, it's that time of year, holiday season. People's schedules are moving and shaking. Everyone's rolling all over the place. Everyone's traveling. So that means I'm rolling solo on the old TWIFO show this week, holding down multiple forts, multiple hot seats, keeping lots of balls in the air here, juggling on the old TWIFO show. Should be a fun one. Let's get right to it. By the way, you guys know how to hit us up, of course, with your questions, comments, and insights over there at Options on the social media, or indeed questions at the optionsinsider.com, or listen in the live chat if you want to chime in there as well. We love all your input here. You guys guide us in some weird directions, which is always fun. Maybe a product you want us to talk about on the show. Hit us up. Let's kick things off, though. Let's go right at it. Let's go right in. Trade war still hot and heavy. Trade war still front and center for a lot of people. Then let's start off in ground zero for the trade war, a.k.a. soybeans. Soybeans, of course, coming in a little bit lower today. That's kind of after they spiked off the heels of China making a pretty much near historic purchase. You know, for a while there, China was saying ixnay to the Oybeans, say there, in terms of buying them, digging up my old pig Latin. Yeah, they were not buying them as part of the trade war. Obviously, soybeans, one of our major exports to China. Now we have maybe a little bit of a détente. They're deciding to pick up some of those to the tune of, you hear different reports, Reuters and Bloomberg, others coming out with different numbers. You see 1.3 million, 1.5 million, upwards of 2 million metric tons of our supply. Either way, it's a historic amount of beans that they're gobbling up. If its initial reports were 1.13 million, that number alone puts it at the 9th largest one-day soybeans buy in over a decade. So if it's at 1.5 or 2 million, that gets even higher up that list. So even if you don't watch beans, then put that number in perspective. That's it's a pretty substantial buy. So China, you know, putting their money where their mouth is. They're making some meaningful inroads here on that trade war, and hopefully this will alleviate some of the concerns over there and some of the heat that's been felt out there in the beans of late. Let's pull up the old quick strike now to see how that's playing out in the option space. You guys, of course, can play along. If you don't have quick strike, head on over to cmegroup.com/TWIFO, TWIFO, and you guys can play along with the kind of the introductory level version over there. See some of the reports that we're talking about here. Of course, if you have it or you want to check it out, quickstrike.net is the place to go. That's QUIKSTRIKE, or Bantix, BANTIX.com. I know it's confusing. Multiple URLs will get you there. And then you could sign up for Quick Strike, kick the tires. If you're trading this stuff and you're not using it, I honestly don't get it. It's worth it almost just for the quick skew stuff alone. I really don't know any other platform that does this. And you can see how the skew is evolving in real time and over the historical basis. That alone is worthwhile information if you're out there doing any sort of trading in these options. Let's look at the beans here. As I pull them up in Quick Strike again, you just go to the ags and then check soybeans. It's pretty straightforward here. You're seeing the beans come into showtime right around 910. They're off about 10 handles now for the week, but still over that 900 level, which is, of course, kind of a key level. They had broken well below it in the past, kind of rallied back up to that level, now maintaining it. That Chinese buy kind of helping here as well. Even for the week, they're off roughly 1% here. In the futures land. Vol also coming off pretty much across the board. A lot of that probably coming in as a result of that Chinese buy, maybe taking some of the tensions off the table there, off roughly a point in some quarters. There's a bit of a mixed bag. Some points of the term structure, obviously with these ags, they have a little bit of a seasonality to them, so that's gonna change it a little bit. But in general, vol coming off across the board. If you're asking, how's the skew looking out here in the beans? I would tell you that it's an interesting beast here. Coming into this week, we actually saw the calls getting a little bit more lift, a little bit more love out here. Let's look out here. Most of the action this week was in the Jan contract. About almost half, 45% of the options volume was coming up in Jan. So let's look there. And in the Jan, we saw the calls about 3% rich to the at the money, so they were bid, but slightly. This week, it's about 6, so pretty much double the degree of bid that it was last week. The puts also coming off a bit. They were pretty much even to at the money, out of the money puts. This is your typical 25 delta put, 25 delta call, so your 50 delta risk reversal. Now they're about 3% cheap to the at the money. So the puts coming in, the calls getting bid, all that may be reflecting what people were anticipating, this big buy come in from China. Maybe now that it's happened, well, maybe that will change. But interesting stuff here nonetheless. Like I mentioned, 45% of the action coming in the Jan contract. A fairly active week, not a rock'em sock'em robots week, but a decent week for the beans. OI up about 3% or growing by about 18,000 contracts this week. The big action, like you mentioned, was in Jan. I said we're hovering right around 910 right now. So not surprised it was near-term out-of-the-money calls that were taking the number one spot this week. 920 calls in Jan, doing 10,500 contracts this week. The lion's share actually coming on Monday, about nearly 4,000, and the rest kind of even. Today actually kind of light, only 800 contracts on the tape. The lion's share of this activity actually closing. So a lot of people maybe had some optimistic outlooks for the upside, or maybe they were doing a little bit of overwriting. Either way, this slightly out of the money call strike getting closing to the terms about a third of this paper net closing here on the week. So maybe people deciding we've seen a bit of a near-term top in beans. Interesting stuff here. Number two, hot on its heels, are the 940 calls. So even more optimistic, doing about a little over 9,000 this week. The lion's share coming on Tuesday. Actually, no, excuse me, Wednesday. 3,500 going up on Wednesday. So a good chunk of those going up on Wednesday. About 3,000 on Tuesday, 1,800 on Monday. Again, a light day today, only 800 and change. So today's big news, apparently not driving a lot of beans action in today's session. 9,100 on the tape, about 1,000 of that closing, so slightly closing to the far upside there as well. Then we got some puts, as you might expect, the par puts, 900 puts, taking number 3 spot, about 9,000 on the tape, about 3,000 going up yesterday. So pretty much the lion's share of the volume the rest of the week. Actually, decent paper today, about 1,900, almost 2,000 on the tape today. So that shows that this kind of near out of the money, very even level, still top of mind for a lot of people. OI slightly closing, but again, we don't have the numbers for today's paper, so that's about 2,000 of that 9,000 on the tape. So could be a good chunk closing coming in here today as well. And we got number 4 and 5, we got the 9.5 calls, 7,000 contracts there. And number 5, let's just scan around really quickly. Actually, it's going to go out a little bit. It's going to be the 860 puts in, what we got? In March, 860 puts doing 6,500, taking in our number 5 spot. So it's not all Jan. It's mostly Jan, but it's not all Jan here. Let's just scan around really quickly, see if we see any other interesting prints here in the beans. Don't get a chance to do a lot of ag love, so I thought we'd kick it off here. 900 puts were lighting it up out here in March as well. Excuse me, to the tune of 6,300. So maybe, and no, it doesn't look like any verticals, even though the OI, the total volume lines up pretty nicely. 6,500 on the 860 puts and 6,300 on the 900 puts. But the days, they don't match up. So there's no verticals going up, even though it looks like it. About for the 900 puts, it was 2,000 today and 3,600 on Wednesday versus 2,000 on Wednesday for the 860s and about almost 3,000 on Monday. So different days entirely, but still interesting stuff lighting it up out here in March. Let's go out here a little bit. Not a lot of long-term paper that's lighting up things. So interesting. Let's kick things off. A little bit of beans love. It is, after all, where the trade war kind of lives and breathes right now. So you can't really talk trade war unless you're talking a little bit of beans. I know what you guys are waiting for. You want us to get to the Texas tea, the old dark and sticky stuff. So let's do it. Let's get on over to WTI. If you're playing along on the reports, listeners, go up to that drop down, select energy, then select WTI, and then parentheses, it says American next to it. It's pretty obvious. And then once you got that, you've got the good stuff here. You'll see here coming into the show, we're at about 52 level, so off about a half a handle for the week. Not a huge move here, kind of unched now after seeing a lot of back and forth in crude over the better part of the last few weeks. Vol, as we said before, also has come in hard. That's because it just got it's got ridiculously elevated going into that OPEC. It's the typical event risk. You see it with an earnings and an equity, a crop report and an ag, and you see it with OPEC meetings and crude. It's the event risk, and so it builds up. I've used this analogy before. It's like the proverbial balloon. It builds up and builds up and builds up, and once the event happens, it kind of pops, and all that volume and all that volatility comes out. You need a big move to offset that. And we did have a decent move in crude, maybe not enough to offset all that vol. That balloon popped pretty hard. We're seeing it off quite a bit here again this week, off, vol off, 4 handles in the weeklies and Ds, going out a little bit to the Jan contract or even beyond. You got 2 points in vol out here. So Feb contract off, what do we got off? Nearly 2 handles in the at the money vol there. So it's been just a drubbing across the board. I think so much so I think even the Journal picked up on it with a piece this week about crude vol and how the VIX of WTI took it on the chin. Again, they quote percent of percent. I know how that drives you guys nuts, but they quoted the biggest percent drop in like OIV, I think history, something along those lines. So even it was big enough even for those folks to pick up on it who don't really watch crude vol all that often, I would wager, out there. But yeah, interesting stuff out here in crude land this week. OI fairly strong, up about nearly 2% so this is a pretty active contract to begin with. So when it's growing 2%, things are moving and shaking. Jan also where the action is this week, pretty similar to soybeans, nearly half, 48% of all the volume coming in this front month Jan contract, which now has a day to go. So this one's pretty much ready to go off the board right after the show is done here. So nice of it to stick around long enough for us. And if you're saying to yourself, what was the big trader, the number one with the bullet, the hot action point in WTI this week? If you were looking at where the levels are, hover on 52, if you said to yourself, probably nice even number, probably concerns to the downside, so probably a put, you would be spot on. It was the 50 puts here in Jan, number one, with a bullet this week, nearly 30,000, about 29,000 on the tape here, active all week long, 7,000 on Monday, about 5,000 on Tuesday, 7,000 again on Wednesday, almost 10,000 hitting the tape today. So we're net closing by about 4,000, but we don't have today's numbers, obviously a big chunk, about a third going up today. So we'll see how that affects the OI, but it looks like a lot of people closing, getting the heck out of Dodge, or maybe doing some repositioning there on the 50 put strike, as that we flirted with that strike, then came away with it, then we flirted with it, then we bounced off it again. It's been intriguing. Then we broke through it very quickly, got back up above it. So the 50 strike has been kind of where a lot of the attention, a lot of the focus has been. Not surprising that we're seeing the options reflect that as well. Before we keep going, let me break down a little bit of the skew as well. I know a lot of you like to trade yourself some skew. What's been happening over the past week? We said the vol has come in commensurately. What does that usually do? It's going to probably bring in the wings a bit as well. Let's see if that's what's happening out here. Let's look at the most active contract, which is the Jan. Again, it's kind of hard to talk skew a contract that's got a day to go, but that's where the action is, so we're going to do it, even though it's mostly a gamma beast at this point. But we're seeing the vol, like I mentioned, the calls were actually discounted to the at the money. The calls were cheap. They were about 8.5% cheap to at the money versus the puts were about 12.6% bid to the at the money. So the bid was all to the puts a week ago. This week, the calls have come in. They're pretty much in line. They're unch, which again, day to go. So bear that in mind. And the puts have also come in quite a bit, down to about only about 4% rich to the at the money now versus almost 13% a week ago. So again, those wings have come in kind of like you would expect when you get a big vol crush like this. So not a lot of ton of stuff changing. Let's go a little bit farther out. Let's see if you see anything a little bit different here in some skew lineup. Let's go. Let's see, where else is there some action? Let's go to Feb. Why not? Feb, we're seeing the calls. Similar story. Calls have come in. They're about 9.5% cheap to the. The calls got a little bit bid this time, actually. So the same deal with the calls before. They were 8.5% cheap. Now they're pretty much in line, so they got bid in the Jan. And same thing happened in here in the Feb contract. They were about 9.5% cheap to at the money. Now they're about 6.6%. So coming in about 3% there. The puts were more bid. The puts were about 9.3%. Bid to the at the money. Now they're a little bit shy of 8, about 7.7%. So the puts coming in a little bit, the calls getting a little bit of a bid. Again, we're vacillating through that 50 strike, up and down. So that could reflect a lot of that there as well. So calls getting a little bit more love. Again, the Jan stuff, take that with a grain of salt because that's going away in a day. But the Feb got a little bit more time on it, a little bit more meat on those bones, a little bit more perhaps to be read in there. Let's see. We said the 50 puts, number one with a bullet. Let's see what else we got lighting it up out here. Number two are the 54 calls. So it's not all puts all the time. 50-54, that's the strangle of the week, I guess, here. Looking pretty tight out there in crude land. Two handles to each side, kind of makes sense. 22, almost 23,000 on the tape. Lion's share coming on Wednesday, about 11,000 lighting up the tape there. 5,000 on Monday, 4,000 today, 3,000 on Tuesday. Lion, about 3,000 net opening, so a lot of back and forth trading on the 54 strike, as you might imagine, followed by the 52s. So pretty much at the money calls now. 20,000 on the tape here with about 8,000 going, almost 9,000 going up on Tuesday. And the rest kind of, 6,200 today, actually, and the rest kind of evenly scattered throughout the week. Slightly closing, about 2,000 contracts closing there. Let's see, then we got, that's number three. Number four, we got the 51 puts, 18,200 there. The lion's share pretty much equal between yesterday and today, 6,600 each on both of those. So take the open interest with a bit of a grain of salt there. Slightly closing, about 1,000. Closing and rounding out our top five. We got, actually, I missed one. It's a 55 calls with about 19,700 trading this week as well. So that would actually be our number four with the lion's share coming on Wednesday, about 11,000 lighting up the tape there as well. Interesting stuff out here in crude. Let's just scan around a little bit as we are wont to do for some aberrant, interesting prints. As you know, if you want to do this yourselves, listeners, I recommend you pull up the expirations tab and hit select all in quick strike. It can be a lot of data, just be warned. But if you can handle that data overload, you can see some interesting stuff popping up on the screen. When you scroll down to the far hinterlands, like for example, the Dees 2020 puts now, someone trading 2,000, nearly 1,800 of those this week. Actually trading throughout the week at 700 today, 900 yesterday, 200 on Tuesday, so a total of 1,800 on the week. Net bias to the opening there, so opening paper on the 35 puts in Dees 2020. So maybe you thought the near-term downside concern was overblown. Someone maybe beating you to it out there in the Dees and saying, no, we got 35 strike to look forward to. Maybe they're harvesting some premium out there. Take a little bit of a dig in there, and you could find out for yourself. Unfortunately, we have to keep rolling here with the show. Obviously, all that stuff rolling out of all the news coming out of OPEC. A bit of a back and forth with OPEC this week, which is kind of interesting. It's always a bit of a back and forth between domestic supply and production internationally. Kind of a similar deal. Actually, a bit of a kind of a conflating deal this week. We have our own EIA data revealing a second weekly decline in crude supplies and a fall in domestic production, that kind of giving a little bit of a lift. Meanwhile, of course, we had all the drama of OPEC last week. They had to delay their cut, a lot of bickering, a lot of infighting, some reporting coming out of, I think it was maybe the Journal, maybe Bloomberg this week, kind of cementing that, saying there was indeed some infighting to get that done. Let's see, even still, they're saying OPEC production rose so much over the past year, particularly from places like Russia. It's going to be hard to undo that. It's going to take a substantial cut. And even still, the gains they made in increasing their overall production could just wipe that cut away. We saw record production from UAE, for example. Their output climbed 110,000 barrels a day. They hit 3.33 million barrels. That means they've surpassed Iran now, third largest producer in OPEC. Similar story coming out of areas like Russia, where their levels were just historic. Obviously, the non-members are the ones who agreed to do the cut. They're going to collectively cut their crude output by 1.2 million barrels a day starting in January. But still, there's a lot of crude coming out of those areas, so they may make it up in the slop over there. So even with non-OPEC production, it's been revised up 190,000 barrels a day, chiefly, again, because of all that coming out of Russia. So that's over year, they've increased their non-OPEC producing levels by 2.5 million barrels a day. So if that trend continues, even if they mitigate some of that, still a lot of crude on the horizon. So yeah, weird stuff going on. Our domestic supply is shrinking, our production maybe curtailing a little bit, but international rallying this week. So it's a weird back and forth dance we have going on in crude, and we'll see if our domestic numbers stay here or if indeed we have a lot going on. Right now it shows what we talked about earlier with the skew numbers here. Interesting stuff to watch here in crude. Let's keep rolling. Quick touch. Let's do a quick touch, very quick, on a Nat Gas, because that one, of course, has been taking a lot of headlines of late, not all of them good. Big move. Nat Gas traders calling it what is, their version of a black swan out there. Just this huge move, aberrant move to the upside. It caught some people hanging. I believe we have a listener question about that a little bit later. Good reminder for quality risk management out here when you're trading your options. But in general, seeing Nat Gas taking a bit of a break this week, off about a third of a handle, right on the 415 level. We're seeing similar numbers. EIA reporting domestic supplies falling by pretty much the levels they had expected. So maybe some of that causing a little bit of this ear to come out of the Nat Gas market this week. Net, it's off on the week. We're off about almost 8.5% out there. Vol also coming off quite a bit. Again, not surprising after you have this just unprecedented move. Vol is going to get jacked up for a while, and it's going to start coming in once you're not repeating that move week after week. And that's pretty much what we're seeing out here across the board in Nat Gas. Let's look really quickly. OI up nearly 3%, so a pretty active week. The lion's share of the action, again, coming in Jan, about 40% of the paper going up here in Jan. If you're wondering what was lighting it up, interesting strikes. I said we're at the 415 level, and that front contract, which is going out in about 13 days, almost 2 weeks. It's the 6 calls where all the action was this week. Nearly 17,000 of those lighting it up. So almost 2 handle out of the money calls for Jan, which is a surprising level. 7,300 of those going up on Tuesday, 8,500 going up on Wednesday. Excuse me. So big prints going up on those 2 days. Also the 5 calls trading those days. So maybe some verticals, 5, 6 verticals perhaps, but the numbers don't line up quite clearly enough to say definitively without having taken some time to dive into the blocks if those were indeed related. But big paper surges on both of those days. I think it's more just the volume on both of those days than anything else. Looks like about 17,000 of the 6 calls and about 15,000 of the 5 calls going up this past week. So far out of the money call action. Opening in both, size opening on the 5s, about 6,000 contracts this week, about 1,000 on the 6s. So back and forth more on the 6s, which is interesting given the size amount of OI. Maybe someone decided to put it on Tuesday and took it off on Wednesday. Maybe it was a near-term play because we had opening on Tuesday and then closing OI on Wednesday. So that could be a little bit of two. Maybe someone deciding discretion, the better part of valor. They wanted a very short duration move there in Nat Gas and didn't see it developing. Either way, surprising paper here in Nat Gas this week. 6 calls where the action is. Let's go on, keep on rolling. Got to talk equities. Equities, of course, if you like equity vol, all that fun stuff, we do a full show breakdown of it on every Friday on volatility views. Here we like to break down what's going on amongst the different indices. Obviously, my buddy Sean from FTSE Russell, he's traveling here during this holiday season, couldn't join us here today. But we like to talk a little bit of the mix of S&P vol versus Russell vol and see how that kind of shakes up. Easiest barometers for that, of course, the VIX and the RVX. VIX, of course, the S&P vol, and RVX being the VIX of the Russell 2000, effectively. Right now, coming into showtime, they were at about 21 for the VIX and about a 24.5 for RVX. If you follow small cap vol, small cap vol historically more bid to the upside there than a little bit richer than large cap vol for obvious reasons. Small cap's going to move around more. So we're seeing that spread widening out again. It got really tight. It got down to about 1.5 or less. Now we're seeing it at about 3.5 handles. So roughly double a little more than double what it was this time last week. So that spread has widened out again. A lot of that doing just to the velocity of the VIX. That thing moves around a lot faster than the RVX does. It just whipsaws all over the place. Again, it's the VIX cash. It's kind of just this little bit of an aberrant index sometimes. Has a mind of its own. And so that's going to reflect really with the lion's share that spread's coming from. Right now, we're at the wide end of that. I know a lot of you like to look at Russell vol versus the S&P, maybe lining up some vol spreads there. And that's pretty much what we're seeing out there in terms of the vol spread. Let's go on again. If you're playing along, listeners, in the reports, go on down to equity indices. And then you click on the old Russell 2000. You'll see what's lighting it up out there in Russell 2000 options this week over there on CME. Again, I recommend you go to select all on the expirations, but to each their own. Whatever you like. You can look at just the main ones too. I like to see the select all to kind of get the full panoply of the options action. This week, OI strong again in Russell 2000 options, up about 7.5% on the week. So yet another week, another strong growth in OI. We're seeing, Russell 2000 at about 1430, off about 20 handles coming into showtime. The vol coming off, again, as you're seeing vol coming off across all the equities here today and this week in general, except for earlier in the week when we saw the big sell-off on Monday. Right now we're seeing, let's see, with about 1430 where the at-the-money is, 1480 calls. Doing the lion's share of the business this week, lighting it up to the tune of, let's see, a fair number here. And a lot of that opening. So opening positioning on the 1480s, which is kind of interesting. Also a lot of 14 doubles trading today, almost the same number as 1480. So maybe some 14 double, 1480 vertical. Interesting, about a 25 handle vertical. I can maybe see an argument for that. I like the vertical better than I do the outright 1480s, that's for sure. So if you're playing that way, maybe a better place to roll out there. In terms of skew, let's look here. Again, we're seeing the calls getting a little bit more life. They were 7% cheap at the money here a week ago. Now they're about 2%, so coming in about 5 points, getting bid up a little bit more. And then the puts coming in a little bit. They were about 8% rich to the at the money. Now they're about 4%, so coming in pretty much roughly in half there. So puts getting a little bit quieter on the vol side. Calls getting a little bit more love. Maybe again reflecting some of what we've seen, a little bit of the late week resurgence here in good old equities. Let's check on the E-mini really quick too, the S&P. See if we see similar data out there. Again, expirations, select all for those of you playing along at the quick strike, and let's see exactly what we're seeing. That's lighting it up out here. If it is near term out of the money calls, 2640 on the E-mini coming into the showtime, right up about 5 handles now on the week. So roughly unched 5 handles, not a huge move in S&P land. What we're seeing is pretty much looks like in the money calls are leading the dance here in S&P land. In the weeklies, again, you're looking at equities, you got to look at weekly. That's where the tail of the tape is. And 2,600 calls as we've rallied. Now those in the money calls doing a lion's share of the business this week. 24, almost 25,000 on the tape here. Actually, no, I take that back. 2,600 puts are actually doing about double that. 58,000 this week. So that's where the action is. Those are in D's. The D's 20. That makes a little bit more sense than those meaty calls from before. So 2,600 puts lighting up. The 2,600 put is kind of is the constant across the board, actually. We're seeing it in the weeklies, the D's weekly, 2,600 put. Actually, that was weeklies. That was puts before too in the week twos as well. So 2,600 put is kind of the strike du jour. Pick your month out here. It's doing a lot of paper out here. So 2,600 put, where the action is, a little bit different story than we're seeing in the Russell 2000. But again, a little bit older, a little bit more involved options market out here in the E-mini. You know, Nick couldn't make it on the show today, but I'd be remiss. He'd be mad at me if I didn't touch on his favorite stuff, which is the shiny stuff, which is, of course, gold. Let's see what's lighting it up out here in metals land. Again, same deal. Click on the drop down, go to metals, go to precious, and then go to gold. And then if you're playing like me, you hit select all to look at all the stuff. We're seeing gold taking a little bit of a break now. We saw some concerning, maybe for gold traders out there, comments coming out of Draghi over there in the ECB, warning about some risk for the future, where they termed undefined risk, and maybe the prospect of raising rates, but doing it towards the end of next summer. So very distant. Who knows what the hell's going to happen between? We don't even know what's going to happen at the end of the week with the tweets, let alone talking about next summer. It's a little bit of a long term. That's his job. I get it. But yeah, he said the risks surrounding the euro growth area growth outlook can still be assessed as broadly balanced. However, the balance of risk is moving to the downside, owing to uncertain geopolitical factors, protectionism, market volatility, etc., and so on and so forth. All this kind of weighing on gold today. Seen coming into showtime, 1245, off about 10 handles on the week. Gold vol coming back in. You know, I've said it before. If it catches a bid, it's going to slip through your fingers again. That's exactly what happened again this week. Off about pretty much 2 points across the board. So gold vol, short-lived, is once again playing out that narrative here this week. OI up about 4%, so a pretty robust week for gold options. Let's look where the lion's share of the action was. It was in Jan. The Jan contract doing about a third of the paper here this week, listeners. So let's look at the skew in Jan. The calls were more bid last week. They're about 8.5% rich to the at the money. Now about 6.6%. So about 2 points coming in there. So calls not quite feeling as much love. Makes sense. We're selling off here this week. The puts also, looks like the puts also Actually, the put's actually catching a bid here too. They were 7.5% cheap to the aftermarket. I know it can be a little counterintuitive when you first look at it, but 7.5% cheap. The small p means cheap, listeners. The capital is the expensive, the lowercase is the cheap. Cheap to the at the money, and coming in this week, they're about 3.3%. So getting bid up about 4 handles there. So puts catching a bid, calls taking a little bit of a break. Not surprising. We're seeing a little bit of a relaxing in the futures there this week. In terms of where the action was, the big print this week, number one with the bullet out here in Goldland. Let's see, there's some trades actually across all the term structure here, but the 1275 calls in Jan were the lion's share of the action. They did about 7,500 this week. The lion's share coming on Monday, about 4,300 on Monday. Followed hot and heavy by the 1260 calls, also in Jan, 6,200 or so. About 2,200 going up today, and 2,600 going up yesterday. The rest kind of scattered throughout the week. Nearly 2,000 opening, but again, today's numbers we don't know. On the 1275s, they were kind of unched on the OI, so a lot of back and forth, interestingly enough, on that 1275, slightly out of the money strike here. But also seeing action a little bit farther down the curve. Dees 2019, again, gold, long-term plays, not surprising. The 1,400 calls in Dees 2019, also very active, 6,100 of those on the tape. 4,000 on Tuesday, 2,000 on Wednesday, 100 today, making a grand total of 6,100. Pretty much all of that opening, a good chunk of that, at least 4,400 or so. So half of that Tuesday paper is opening, which is interesting. But still, a lot of opening paper on the 1,400s. So these are optimistic, but again, gold bugs, they're known for their optimism. So interesting stuff here. Let's look really quickly at any other aberrant prints. Big prints, 1,300 calls in, where we're looking here, 1,300 calls in June. Also very active this week, 5,600 of those hitting the tape. Pretty much Tuesday, 3,300, and 2,000 on Wednesday. So a smattering of months, a smattering of strikes, a smattering of outlooks there. But it looks like lion's share of it biased to the upside there, which is interesting. Again, kind of reflects what we know about the gold audience. They like themselves a little bit of upside. Talking upside, unfortunately, there's not much to be found these days when we're talking all things crypto. It's kind of just been a sea of red on the screen. I was talking to a lot of crypto people yesterday and just about what this sell-off has meant for their funds and their analysis and the interest and all sorts of other things. If you like crypto, we'll be getting into that a lot more starting in the new year with our new forthcoming crypto show. So we've been waiting a while to see how this marketplace shakes out, see new products line up. Unfortunately, didn't see new products line up, but we're going to dive into it anyway with some interesting stuff, so stay tuned for that. Bitcoin, again, feeling the heat today off the CME future right now at 3285. Remember, it was a big deal if it was going to break through the 4,000 strike. Well, it did that. It was going to break through 3,500. Spoiler alert, did that too. Now today off another 135 handles, 3285 the last print on that Dees future. Decent volume, 2,600 contracts going up out there today. So remember, that's a 5x contract. So you're talking over 10,000, but still total coins. But still, it's still a bit of a rout out here in crypto land. It hasn't really hurt the futures, though. Looking at the CME setting a record back for Q3. Obviously, you don't have the Q4 numbers yet, but they hit an ADV record of over 5,000 contracts. 5,053 contracts in the third quarter. That was a 41% jump from Q2 and 170% increase from their first quarter of 1,800. So that thing's been growing steadily over that time. Also, talking about growing steadily, this sell-off comes on the heels of an interesting new study coming out of Cambridge University, where they determined that the overall number of crypto users has nearly doubled over 2018. I think you can take the term user very broadly. Could be people trading out there, people actually using the underlying tokens and coins for what they're supposed to be for. So not all these people are out there slinging the coins. They say obviously the sell-off has hurt it with total market cap now at about 109 billion. Today's sell-off is going to reduce that again. But still, even with the volatility and sell-off, the numbers have doubled for users, even though Cambridge pretty much cites that this number has doubled from 18 million to 35 million. But still, they say the lion's share of these users remain passive, which I'm going to take to mean they're not out there slinging and trading these things on a daily basis. It's more, they say they're, let's see, what do they say here? The industry becoming more fluid as the line between exchanges and wallets are increasingly blurred, and a multitude of cryptocurrencies, not just Bitcoin, are now supported by a growing ecosystem fulfilling an array of functions. That's pretty much is what I assume. They're saying that people are out there, as I mentioned, users. So they're not just slinging the Bitcoin. They're out there actually trying to use them for what they were initially intended to be, which is could be interesting, could be anathema to those out there who want to trade it actively out there in all things crypto. But interesting stuff. I think we're all still hoping for a little bit more in terms of product offerings. That'd be kind of nice. And then obviously once you have options, how nice would it have been to have options on the run down from 20,000 down to now shy of 3,500. Would have been pretty cool, but c'est la vie. Past is prologue. We'll see what we get coming up here in the new year. Speaking of what we got, let's look really quickly here. The big movers and shakers for the week here on CME. These are just pure futures movement now. No volatility, no OI, no nothing, no options, just pure underlying movement. What's lighting it up here? On the top, on the upside, we got KC Wheat up nearly 5%, 4.9%, followed number 2 by iron ore, 4.4%. Number 3, Palladium at up 4.3%. Number 4, wheat, 3.78%. And round out the top 5, good old RBOB gasoline, 3.1%. On the downside, we've got Nat Gas coming off 11.5% this week. As I mentioned, Nat Gas feeling the heat. Number 2, rough rice, off 3.5%. Number 3, the E-mini Russell 2000, 2.8%. Lean hogs, number 4, 2.84% or so. So 2.86 and 2.84. So pretty much tied there. And rounding out the bottom end of the top 5, the S&P E-mini off 1.72%. All right, let's get to it. It's just me, so I want to make sure I rope in some of your guys' questions as well. Let's get to a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, let's do it. A little bit of your futures options feedback. First up, JLN7. He wants to know, excuse me, is it safe to write calls in Nat Gas again? Well, yeah, long answer is that it's kind of always been safe if you do it right? That's the takeaway from all this stuff. Obviously, if you did it into the teeth of that deal, if you did them, you still would have lost money if you didn't. But you do them the right way. You do them in a risk-mitigated fashion. So instead of selling naked out-of-the-money calls, one of the riskiest trades you could do in the entire odds. Everyone freaks out about puts, but puts have a defined downside. Calls have no limit. There's no barrier. So it's like shorting a stock. There's no limit to how much you could lose. Shorting a call naked, same thing. So that's what we saw. We saw the risks of naked, unmitigated selling into an historic up move. Yeah, that's going to be dangerous. And unfortunately, we saw that wipe out people, which is the worst case scenario. That's what you don't want to have happen. Losing money, not the worst case scenario. Wiping you out and your clients, everyone else, that's the worst case scenario. That's what you can't afford to have happen. Losing some money, you could deal with that. If you do it in a risk mitigated fashion, it's just a small percentage of your portfolio. You'll live to fight another day. So yes, if you do it risk mitigated, doing it as spreads, the ways we've always advocated here on the show, not just out there blasting away at whatever, 4.5. Back then it was probably 4 or 3.5 calls and just selling them naked because they look juicy. No, that's never the safe way to do it. But if you do it in a risk mitigated fashion, even if there's aberrant events happen, you'll live to fight another day. So yes, it's safe to do that if you do it in a risk mitigated fashion. If you're going to go crazy town, then all bets are off, and we saw what happened. Those trades work until they don't, and when they don't, they really leave a mark. Let's see here. People are asking about a bunch of stuff about WTI. I want to save that when we have more people on the show so we can all kind of weigh in equally here. Let's see. Mainev, Maine EV, maybe he's an EV fan. I don't know. He says he didn't quite catch the logic of the guest on your last show regarding the equities strangles. He said, how would selling strangles help you rebalance your equities portfolio? Thanks for this. Also enjoying Options Playbook. Oh, another listener with good taste here. Options Playbook, our education-oriented program put on by our friends over there at Ally. Good show there. What he's asking about, remember listeners, last week we had Russell Rhodes, formerly our buddy over there on Volatility Views, now doing duty over there at Tab Group, putting together an interesting white paper talking about strategic uses of options across a broad array of futures asset classes. He talked metals, he talked, ags, he talked equities. And what he used, his example in the equities, I just pulled it up here to refamiliarize myself with exactly what he was talking. He was talking about rebalancing between the S&P 500 and the Russell 2000. He was actually looking at, looks like he's selling ratio strangles here. So in the case of the S&P 500, his example was selling 250 of the 2,600 puts against 200 of the 3,200 calls. So you have the underlying here. You're selling downside puts, more of them, and then fewer upside calls. He did the same thing here with the Russell 2000, selling about 600 of the 1,500 puts and only 470 of the 1,900 calls. How would that rebalance, says our listener, Mainev? Well, it's pretty straightforward. Remember, you have these equities in your portfolio. You want some sort of tactical allocation between them. You have some sort of makeup that you want, your desired outcome for your portfolio. Now, as these things rally or sell off, they're obviously going to be underweighted or overweighted more. So that's pretty much what Russell was talking about. He set up his strangles to reflect that. So in the S&P example, for example, if he gets to 3,200, he's willing to sell out a portion of that S&P portfolio because it has become overweighted now because it is very price heavy. And so he's selling some of that off the board. So he's selling strangles there. That's what remember, these are strangles that are, the upside is effectively covered. The downside, he's looking to buy more, again, to rebalance because the underlying is dropping. The equity is getting less valuable. It's going to be underweight in their portfolio, so you might want to buy some more at those levels. So that's why he's selling more of the puts than he is of the calls. So if you think of it that way, the strangle is a good way, especially on the ratio here, to kind of rebalance your levels. You look at, you have an equity in your portfolio, you're saying, well, I wouldn't mind selling at these levels, you're at a covered call there, and you wouldn't mind buying more at these levels, you're at a put. Maybe you want to buy more than you want to sell, you do it on a ratio, maybe you want to sell more than you want to buy, whatever your flavor is. In this case, he was looking to do it that way to keep the adjustments lined up. He did the same thing for the Russell 2000. So it's an interesting idea. It's one, if you're trading a lot of equity indices in your portfolio, maybe you might want to use that as a tactical way to reallocate some of your exposure to different indices. I thought it was an interesting idea. I think it makes a little bit of sense once you think about it there, Mr. or Mrs. Mainev. Good question, though. Let's see. Neal J wants to know, does put call parity work the same for futures options as it does for equity options? Thanks for all of your free content. Well, the short answer is yes. The long answer is I'm trying to think of some scenarios where it would, go haywire, and that's where you would probably think of some of the differences coming in. Because obviously that's where you see these moments where things kind of fall apart, these extreme disassociative events. Maybe it's a corporate event in an equity, or it's some kind of crop report crazy thing happening in the ag, or some sort of other crazy imbalance that would cause it to come out of whack ever so briefly. Again, these things, if it goes out of whack too much, people are going to start hitting that pretty quickly. It's effectively free money. If the puts are extremely jacked to the calls or something like that, or vice versa, if that happens, it's short-lived, and usually reflects some sort of crazy other imbalance. Maybe an equity that's really hard to borrow, and people want to get shorted in a freaking heartbeat because they're really terrified about something happening in the next minute. Maybe you might see those aberrant moments where it breaks up. But otherwise, yeah, put call parity is one of those kind of one of those laws of the jungle there. It's kind of hard to break, and if it does, it gets back in line very, very quickly. And you're welcome, Neal, for all the free content we create for you guys. Brandon Elliot has a question about rules of thumb for term structure in seasonal ags like corn. I'm going to table that one too, Brandon, because I just don't trade a lot of corn seasonal spreads, so I wouldn't want to weigh in on that. I want to save that for someone who does a lot of that, so they can talk about. Because I'll do it. I'll talk you from the equity perspective if you want, or the index perspective. But from the ags, I haven't done enough of them to where I really would want to pontificate about rules of thumb. In general, if you're comfortable with all the typical things, obviously you're talking term structure, you're talking calendars and diagonals. If you're comfortable with all the usual caveats that go there, if you're buying the calendar, typically you're getting long vol, short gamma, those types of things. If you're comfortable with that, then you should be able to wrap your head around the ags. But again, the ags are kind of unique. They kind of have their own rules of engagement. So I'll let someone who's slings a lot of ag calendars weigh in on that with some very specific ones for you. So we'll save that one for you there, Mr. Elliot. Let's see. All kinds of stuff here. Oytrate. His handles are all over the place today. What is the reason that someone would write in the money covered calls? Seems like a waste of time to me since you're capping all of your upside. It can be. Depends on your outlook on the underlying, right? If you're in a booming biotech and you expect this thing to double overnight because of an FDA ruling, yeah, you don't want to write an in the money covered call. That's kind of a waste of time. If you have kind of a sideways blue chip that you don't think is going to do a lot for the near term, and you want to juice up your covered call returns, you do these regularly, weekly, quarterly, whatever. In the money covered call can be the way to go. It could jack up. I've seen a lot of you could do the research yourself and crunch the numbers, but it can jack up again because you're getting into the put wing now, which is a little bit more elevated from a vol perspective than the call wing. Call wings are usually discounted, so you're getting less vol to sell those, but you're giving yourselves appreciation ability. So it's a bit of a trade-off. If you expect a lot more capital appreciation in the near term, you do not want to write an in the money covered call. If you, of course, expect maybe a little bit of a sideways market, you want to capture a little bit more of a vol pop, in the money covered call can be the way to be. Just remember, you have to have the caveat that your stock could get called away. So you have to have the flexibility from a tax perspective and everything else, have your underlying get called away, or you have to be deft at rolling. If you're cool with that, then this could be a way to go. Some people I know prefer that way, actually. Over time, that little bit of extra juice can add up, but it's got more work involved, more need to roll, more need to babysit. Maybe that's not worth it for you. But it can be, net return-wise, it can be a winner. But even though it seems counterintuitive, and in these long bull market runs we've had, people don't want to cap any of their upside. So I could see why you'd have that question. But in a sideways kind of vacillating market, maybe a little bit meatier covered call may be the way to go. Here's a question about rates. That's Nick. Nick would be upset if I'd answer that without him, so we'll save that for him. Let's see. There's another. Let's finish up on this one here. More people have all this. I think this is related to some listener questions we had a while back. This is another guy commenting. He thought the user tip to exercise more deep in the money call question. This one's coming from Kelly Leff. Thought the user tip to exercise deep in the money calls to save on the spread was a good one. That harkens back to a question we had a few weeks, maybe a month ago, listeners, where a listener was talking about if they had a call position on, and for whatever reason they wanted to exercise it early. Again, this was when we had a lot of questions about early exercise, which isn't a thing you can do a lot of in the futures option. So interesting. But c'est la vie. You guys have your own threads you like to go on. And so they thought maybe if you couldn't, for some reason, sell it out, you could exercise, the spread was too wide, you could exercise the option. Maybe that would save you money. Interesting theoretical idea. This person's following up on that, saying, thought the user tip to exercise deep in the money calls to save on the spread was a good one. So I checked a few of my stock replacement positions that had gone in the money. Turned out the spreads were fairly similar to the spread on the underlying stock index. So any savings were pretty small, not really worth the hassle to go through the exercise process. Maybe I'm just trading a more liquid index than that listener, or am I missing something? No, I don't think you're missing something, Kelly. I think that's pretty much what you're going to find. Once you get that deep in the money, what is your call option, right? It's just stock at that point, or whatever the underlying is, the future, So it's going to reflect a similar spread to that. If it's much wider, then they're doing something wrong, and you shouldn't be trading that. If the stock or the future, whatever, is only like a dime wide or 3 cents wide, and your in the money call is 50 cents wide, yeah, that's not a place you want to play. So you're going to see that reflected. I mean, market makers aren't idiots. They get the liquidity they can get. They can get liquidity in the stock. They can hedge it almost instantaneously within the money call, so it's not going to be that wide. So, yeah, it was, as I mentioned, it was a theoretically interesting idea because the practical applications of it are pretty small. You have to find this weird aberrant scenario where the spread on the underlying is actually wider than the in-the-money call. I don't see that happening too often. If that's the case, then something weird is afoot. And maybe that's probably an underlying you don't want to be trading in anyway. So yeah, theoretically, we thought it was cool. We didn't think it had a lot of practical purpose. I think you're starting to see why they're Mr. or perhaps Mrs. Kelly. We don't know. We don't judge. We just like to read your questions here on TWIFO. There it is. All right, listeners. There's the music. Going to cut it a little bit short this week just because we got so much more questions. I want to save some of them Some of these ones are on some interesting product categories. I'll make sure the other guys have a chance to weigh in as well. So I'm going to save a few of those. But great questions. Keep them all coming. We love to hear from all your stuff. You guys want to know about WTI Brent spread. You want to know about skew and WTI. You want to know about ag diagonals and calendars. All kinds of fun. Cattle. I didn't even get a chance to get to the cattle one. All kinds of good stuff. So keep them coming. We love your questions about weird, esoteric products and strategies and use cases. We love it all. Gives us great grist for the mill, great food for thought here on the show, great discussion topics, maybe ideas for guests we can bring on to discuss these topics as well. So keep them coming. We love to hear from you guys. That music, like we said, means we're coming to a close here. Before we go, I want to thank all my cohorts who are busy traveling hither and yon. Couldn't join me today. Check out my buddy Sean over there at FTSE Russell, FTSE Russell.com for all the data on indexing, passive versus active. A lot of the benchmarks talked about for call overriding and things like that too. All that data is available there. You can also follow him, FTSE Russell, FTSERussell.com, or just what's at FTSE Russell on Twitter. A lot of that data coming out there as well. Mr. Nick, you know how to find him. QUIKSTRIKE1 on Twitter. Head on over to Bantix, BANTIX.com. So you sign up for his platform. Things falling down on me in the studio here. Or indeed over there to quickstrike.net. Again, if you're trading these things, you're not using QuickStrike. What are you doing? How are you not using this stuff? It's really what you need to be looking at. Quickstrike.net or Bantix.com. And of course, our friends over there at CME Group, you know how to find them. They have the great tools. OPEC Watch tool down now because there's no OPEC meeting, but there's still the Fed Watch tool. Hot and heavy, a lot of things changing out there. So keep an eye on that, as well as all the other stuff. You can head on over to the CME Institute to get your learning on in between as well. Always great research papers coming out from our friends like Blue and Eric over there as well. So if you want some new ideas, new analysis, new research done in different product categories, that's the place to go as well. CMEgroup.com for all of that. On behalf of all of them, CME and FTSE Russell and QuickStrike, and indeed myself, I want to thank all of you for downloading, streaming, subscribing, for joining us live, for sending in questions, for all the fun stuff that you do, playing along with our polls week after week. We love you all. We'll see you back here tomorrow for Volatility Views. Otherwise, we'll see you back next week for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.